Stocks have experienced their worst day since 2022, but in fact, this did not just start yesterday. If you look at the overall market, this has been the state of the market. It has been an absolute bloodbath. The Dow Jones is down 3%, the S&P 500 is also down 3%. In fact, if you look from all-time highs, the S&P 500 is down about 5%. Looking next to the Nasdaq, we see that the Nasdaq has actually fallen 4.5% in the last 5 days, but from all-time highs, the Nasdaq is down about 8%. But if you look at our portfolio over here, you can see that on 24th July at about 10 p.m. Singapore time, we are doing quite well. We're up about a total of $1,900, which is about a 12% gain over the last couple of weeks. So in this video, we're going to discuss how we position our portfolio such that although the market was down about 8% in the last couple of weeks, that our portfolio still can be up over 12%. We're also going to look at some of the moves that we make and how we're going to position our portfolio moving forward into August. Truth be told, it is like what Warren Buffett said, most people should just buy an index fund, set it and forget it. Dollar cost average into the index fund and don't look at it at all until you retire, because you basically don't need the money right now, so you can just ride out the volatility. However, if you hope to optimize your returns, possibly beat the market so that you can retire a couple years earlier, then it makes sense to put in the effort to understand your investments. Now, this is not financial advice and we're not always going to get everything right. This is just to hold myself accountable and to document this journey. Because previously when I'm managing my own portfolio, I haven't always been so on the ball. Hoping that through this process, I'm able to build that muscle and to also track my progress along the way so that I can look back and see my wins and losses and my thought process behind why I made some of these decisions. So how is it possible that although the market is down nearly 8%, that our portfolio is still up 12%? I basically attribute this to two different moves that we made. The first one being to close our end phase put at an 83% profit. You see, I mentioned this in my market outlook video that because the expectations going into earnings are so low, that as long as they barely met expectations, I'm not surprised to see the stock rebound, which is basically what happened. In fact, they didn't even meet expectations. They were just not as bad as people expected. And because they were not as bad and gave okay guidance into Q3, the stock basically rebounded. I'll break it down in a little bit more detail later on, but because of this rebound in the stock price, basically our put became profitable and then we basically managed to close it for 83% profit. The second thing that we did is basically to buy and sell the SQQQ for 100% profit. Yes, you heard me correct, 100% profit, which means we doubled our money in this portion of the investment. In fact, I actually alluded to this in the Netflix video, and I can actually see that if we pull back in the market, which actually the Nasdaq actually pulled back about 5% so far, won't be surprised to see it drop at another 5%. What I did was to basically position myself in case that happened. Now, at this point, you may be wondering what in the world is the SQQQ? So basically, like I said, right, because I don't short markets, I don't actually like to borrow the shares, and then because there's an unlimited downside when you actually short the market. And why I say this is because basically I want to take this opportunity to introduce you to this thing called the inverse ETF. Now, an ETF is quite standard. We know things like the SPY, the VOO, and things like that, right? These are index funds. They basically track an index. So the index fund basically tracking the Nasdaq is called the QQQ. And what the SQQQ is basically an inverse ETF. So as the name suggests, the SQQQ is basically the inverse of the Nasdaq, which means that as the Nasdaq goes up, SQQ will fall, and as the Nasdaq goes down, SQQ will rise. And so the reason that we are up and how we made 100% on this is because I actually bought some SQQQ call options on Tuesday to hedge against the market. I didn't expect to be able to take profits so quickly. Let me take you through my thought process on how I decided to get into the SQQQ using call options. So basically the first thing I actually thought of was Biden stepping down. And so basically after the poor debate performance by Joe Biden as well as the assassination attempt on Trump, basically everybody was pricing in a Republican win because they expected Trump to win the presidential election. But after Biden stepped down, now there's basically uncertainty on who is going to be running. Seems like it's going to be Kamala Harris, but we are not very sure. But whoever it is, basically the market thinks that whoever is going to replace Biden may have a bigger chance to beat Trump. And so basically because the path for Trump to win the presidential election isn't as clear as before, the market kind of have to price that in. So I basically won't be surprised to see a volatile market from now leading on to the election. Now the second thing is basically people talk about a rotation into small caps. This is quite straightforward because in the past couple of years, right, people have been actually putting money into all these big tech stocks and things like that, which is why the S&P 500 has been doing so well. However, with rate cuts on the horizons, people are basically positioning their portfolios to take advantage of rate cuts. And in a lower rate environment, usually smaller cap stocks tend to do better. And the third thing would be the upcoming big tech earnings, right? Because I think I was mentioning in my previous few videos that with the big tech earnings, depending on the expectations that they give, that could actually move the market and cause the Nasdaq to actually go lower. So Tesla actually had a pretty poor earnings or below average earnings. And although Google had good earnings, right, they actually gave some bearish comments on AI and the development of AI moving forward. Why I decided to actually get into the SQQQ is I kind of see it like buying insurance for my portfolio. I actually only use about $610, which is somewhere about 4% of the portfolio. And I was very ready for it to go all the way down to $0 because if it goes down to zero, means the Nasdaq goes up and chances are my portfolio is doing even better than the $600 that I lost. So basically that was what I was doing and I didn't expect to take profits on it so quickly. So because if you look at this, just a couple of days ago, right, the SQQQ was about $8, $7.90, $8. However, yesterday you can see this big green candlestick that just suddenly popped up and closed the day at about $9. Basically, you can see here, right, I actually bought 10 contracts of SQQQ with a $8 strike price on 23rd of August for 61 cents. That was on 22nd of July. And then yesterday night, somewhere in the middle of the night, it was actually about $1.14. So at that point in time, I actually started to set some of my sell targets. So the first sell target was hit. I actually sell off 3 call options at 120, which is about 100% profit, which is what I was mentioning earlier. So basically right now, I still have 7 contracts of SQQQ going into August. I don't plan to sell that anytime soon unless some of my targets are hit. I'll talk about the targets later on, but basically this is, like I said, insurance for my portfolio going into August. And basically if the stock market continues to bleed out like what it did yesterday, then at least this position will go up to probably about $1,400 to $2,000, somewhere there. That's what I'm expecting, and I'm going to use that cash to redeploy back into the market to buy shares at that point in time. So let's take a look at some of the other moves that we made in the portfolio just to show you where we stand before I talk about each individual companies. Now, the 650 SoFi put, basically this one was last week, which I already covered in the previous video, right? We actually sold it for 34 cents and then bought it back for 3 cents. So we actually realized a $310 profit. And Face put, the $105 put that we were talking about earlier on, sold it for 402 and then basically bought it back for 70 cents, making a $332 realized profit. The NEO put, we actually also closed it, sold it for 16 cents, bought it back for about 2 cents, so basically $14, right? So $98 profit realized. And then the January 2025, okay, so this is basically one of the moves that we made yesterday. I'll show it to you. Basically January 2025 SoFi puts, because SoFi has been dropping, right? So I basically sold puts at $8 on January 2025. I sold 5 contracts at $1.15. So that amounts up to about a $775 credit. So that is not realized profit, that's just a credit. And then the 3 contracts that we sold of SQQQ, August 24 calls, we actually bought it at 61 cents, sold it for 120, so we made a total of $177. Now, if you don't count the January 2025 SoFi put credits, right, basically everything else we add together, we actually have a realized profit in this account of $917, which is about 5.9%. So why am I calculating this? Because earlier on what you saw, the 12%, right, is basically the overall portfolio gains, realized and unrealized gains. But out of this 12%, $900, which is about half of it, is basically realized gains, means gains that are already locked in, which means if I don't do anything for the rest of the year, we actually already get this 6%, which is, already much better than all the fixed deposits and things like that are on offer out there down today. So basically these are the transactions that you actually see. I bought back the Enphase put for 70 cents, bought back the NEO put for 2 cents, and then I sold 5 SoFi puts basically out all the way to January 2025 at $8 for $1.55 premium. So basically I receive $1.55 per contract. Okay, so we want to talk about our first company, which is SoFi. If you look at the position right now, we have 500 shares at $6.33. And then after that, we have 2 different put options open on this. So we sold $7 puts for 64-cent premium, which means that if we actually have to buy these shares, we're actually buying them for an average price of about $6.36. And for the $8 SoFi puts, why I chose $8? Very simple, because after I net off the premium that I receive, I'll be buying SoFi for an average of $6.45. So basically, because I'm already nearly at a 20% allocation for SoFi right now, I don't want to be too overexposed to it in such a small portfolio. I actually feel okay to actually double my position, which means to hold 1,000 shares, but I'm actually not in a hurry because, like I said, the market, I expect it to be volatile moving forward. So that's why I'm actually selling puts. So if it goes up, I'm okay. I'll collect my premium and my 500 shares basically already have capital appreciation, right? If not, I'll buy more at an average below 650 in time to come and let the thesis play out. So this SoFi position is only something that I'll reconsider after June 2026. I'll explain more in another video where I do a deep dive into SoFi. In general, because rate cuts are around the corner, they are going to increase lending, so I expect revenues to grow. They're starting to roll out new products. I think Galileo just released a new product. And I think generally, right, people are more inclined to adopt new technology as long as they have clarity into the future. I think why a lot of banks and a lot of fintechs are holding off using Galileo right now might be because of the uncertainty in terms of the macro environment, and because of that, they're actually holding off, wanting to keep some cash on hand rather than to basically focus on growth. However, if we have a clearer picture of the economy, and then a lot of these companies could then focus on to growth, and then which basically becomes a more business-friendly environment for SoFi and Galileo to grow their tech platform. So the bull case is still intact. It's been selling off for a lot of what I term as stock-related news, like restructuring of debt, and then like when certain institutions sold off and things like that. But there are no fundamental problems with the company, so that's why I'm holding this until 2026, and then basically we'll reassess it from then on lah. So of course, if this doesn't do well, then overall the portfolio, being one of the biggest positions, will be a drag on the portfolio, right? Which is why we don't want to overexpose ourselves to one position. Now, I think this second company, right, actually has the most interesting developments over the last couple of days. So when we look at Enphase, basically I want to cover three things here. Basically, I want to talk about how come I never choose to roll the options and why I wasn't afraid of early assignment. And then my thought process in case I was wrong. I was very prepared that my thesis was wrong, that even after the earnings, yes, they didn't do as well. And rather than actually having a bounce up, the stock price actually fell even lower. And basically to show you how I think about options and what was my backup plan in that case. And the third thing I want to talk about thereafter, of course, is market psychology. And then I'll basically tie everything together lah. Okay, so Enphase, like I said previously, right, in this video over here, which I'm going to just let you listen, people are generally quite bearish and going into earnings, which sometimes can be a good thing because as long as you beat expectations, then there's a chance that the stock price will run. Because the expectations are so low going into earnings, basically, as long as they show people they're not a completely dead company, they haven't died yet, right, the stock price can very easily rebound, which is exactly what happened. Because when I look at the numbers, right, by itself, it was actually a pretty bad earnings. Missed on revenue, missed on EPS, margins slightly expanded, and even the expectations, right, were improving, but not as good compared to last year. But because they show people that they are not dead, right? So the stock actually jumped from $103 to $119 yesterday night lah. So basically what this tells us is that in terms of the stock market, right, you have to understand that sometimes it's not just a quantitative analysis, but understanding market sentiment and market psychology as well. So basically because of that, I sold the put at $402 or $405 and I took profits, right? So I took a $332 profit, bought back the put to close at about 70 cents. So this basically actually helped me free up capital going into August, which is what I really wanted to do as well. I did not really want to tie up so much capital going into August because I actually expect a volatile market and I want some cash on hand to be able to deploy. Second part to this question on why I decided not to roll, right? Because people ask, aren't you worried about early assignment, like you're already below the strike price and things like that? Basically, I think when we actually talk about options, you have to understand that the price of the options, right, and the price of the stocks are not completely 100% related. They are related in some ways, but not fully related. So let's take a look at the options, right? Basically, this is the value of the Enphase put the night before earnings. So you can actually see, right, I sold the put at $405 over here, which means I received $405 for the put. However, the night before earnings, the contract was actually worth $686, which means I was down nearly $300 on this whole position, which means that I received $400 because when I sold the put. Now, if I want to actually buy to close, I actually need to pay back $686 in total, right? So I'm down nearly $300. Now, basically why I wasn't worried, right, is because when you look at this number over here, 686, this 686, right, is not just fully dependent on the price of Enphase. Now, this $686 have two components. Now, the price of the options, right, is basically made out of this thing called intrinsic and extrinsic value. And as long as there's still significant amount of extrinsic value left inside the contract, you don't actually have to worry about being assigned early unless you're paired with someone that doesn't like money and just wants to throw everything away. How to calculate the intrinsic and extrinsic value in a stock option, right, is basically a whole other video by itself, which I will do probably sometime in the next 1 to 2 weeks after my exam. Okay, but basically you need to be able to calculate these numbers by yourself on some Excel spreadsheet and things like that to be able to have a better sensing on what to do. So because I was calculating this in the background on Excel, I knew that I still had a significant amount of extrinsic value left inside the contract. I wasn't worried of being assigned, which brings me to my second point, right, which is what happens if I was wrong? What if the stock never actually rebound and then I actually got assigned the shares? Now, in either scenario, I was perfectly fine, and basically I want to talk you through the thought process that I had. So if you look at this this Excel sheet over here, right, basically what you can see here, right, is that on 15th of July, I sold a put that will expire on 26th of July at $105 strike price, right? Okay, so premium $402, basically, which is what we have seen earlier. And the current option price is $686. I think when I was doing this Excel, it's $630. That's why it's $630 over here. So you can see, right, I actually have no amount here when I say paid to close. So I basically assume that I don't close the contract, I get assigned the shares, which means I actually receive the full $402, but then this $10,500 will be used to go and buy Enphase at 105. So when that happens, I'll own 100 Enphase shares, basically at $105, right? So total value $10,500. But you have to remember, I actually received the $402, right? And then what I'm going to do, or what I plan to do, is to basically sell a call options on these 100 shares that I own. Now, to sell a call option means that I promise someone else that I will sell them back all these shares at a certain price. Now, basically what I had planned to do here is if I were to sell a call 1 month or 3 weeks out at 16 August, basically I can receive about a $600 to $700 premium. And this $600 to $700 premium will again offset my average cost. So you can see here on the P&L statement, I sold the put 402, sold the call, estimated about $600 to $700 lah. So basically what will then happen is that my total profit from this wheeling strategy is $1,172. When you subtract that off from the cost of the shares, you actually get the adjusted cost basis of $93. Which means if I sell Enphase at $105, I actually make a total of $1,218, which is a 13% profit. Which in 1 month or so, I think that's actually not too bad lah. And so that was the plan, basically. Okay, so I break it down very easy for you. I know the Excel file is quite confusing. I will go into options in a little bit more detail in future. But basically, you can see here, 15 June, sell the Enphase put, got a 402 credit. Let's say on the 26th of July, it gets exercised. I got to pay. That's why minus 10,500. And then I plan to sell a call at $5 to $10 above whatever the price is for a credit of $770. Total, in the end, I own 100 Enphase shares for $9,328, which puts my average cost basis at $93, which I feel comfortable owning Enphase at around this pricing lah. So basically, that's why I wasn't too worried. And the third thing I actually want to talk about is actually market psychology lah. Because if you look here, right, I didn't actually exit my position at the optimum price. If you can see this grayed out thing, is basically the price actually moved down even lower after I sold it. So basically, this Enphase option that I actually closed at 70 cents, I could have closed it for 15 cents, which means I could have received another $55, right? However, to me, at the point in time, honestly, it was not worth the worry because the whole weekend I was actually basically thinking about this position. I don't mind owning Enphase, but I didn't really want to own so many Enphase shares, especially going into August lah. Plus, at the same time, right, I know that because if Trump really wins the presidency, I'm not too sure how solar friendly and how green energy friendly is he. So basically, to me, it was not worth the worry. I was already keeping about 83% of the premium. So I wanted to free up the collateral moving into August. I think that was more important for me to actually free up that to actually free up that collateral. Plus, you know what? I got exam next week. I didn't want to really worry about it over the next couple of days. So the last thing I want really is for there to be a crash and then Enphase actually goes back down and then I have to manage the position, right? So I was happy with 83%. It's basically risk management and controlling your emotions. And I think when we invest during a market crash or during a market that is correcting itself, I think that is very important. Don't just always go and chase the extra $1, $2. Always have an idea that, hey, you know what? I already realized 80% of my profit. Just a couple of days ago, this was actually down 70%. So basically, just be happy with the win. Take the win. Nobody ever got poor taking a profit. Basically, that's what I was told. So right now, before I actually review to you the third company, which is a new company, yes, the SQQQ is not a company. That is just a hedge on the portfolio. I actually brought the third new company into the portfolio. What I need you to do is to hit the like and subscribe button. Otherwise, there's going to be an awkward silence here when I'm waiting for you. Oh, thank you. The awkward silence was killing me. And now back to the video. You can see I actually bought 20 shares of PayPal here at $59.19 on the 19th of July. So that was last week. I actually wouldn't mind increasing this position a little bit. Okay, now I'm going to talk about PayPal, why I decided to buy PayPal. Because PayPal basically has been a leader in the payment space, right? But under their previous CEO, I think they were basically chasing revenue growth at all costs. And then they actually brought on many, I would say, businesses that were not so related to their core product. And so they basically got so distracted by other business lines, which actually caused their margin to compress. So they were actually making more money in terms of revenue, but they were keeping less and less of that revenue, which is basically not a good business to have. So like I mentioned previously, right, I'm really a sucker for good management. So when they brought in Alex Chris, I was actually quite happy because I like Alex Chris over at Intuit and what he did over there. And I think what was enticing for me is that actually PayPal actually still owns 45% of the global payments market share, which is surprising to me because at least in Singapore, I hardly use PayPal. So to actually see that they have 45% global payments market share is quite enticing to me. And like I said, they hired new management. They actually replaced a lot of their management team. Alex Chris actually brought in his own people. The payments market is still growing. So that means the TAM is expanding and e-commerce is strong, right? Which is basically what the market that PayPal is in. They basically power a lot of e-commerce platforms. So PayPal makes most of its money through transaction revenue, which means that when I'm online, I buy something, right? I pay $5, maybe PayPal takes a cut of that. Okay, so there are merchant and consumer fees, and basically that's how they operate. So I think for PayPal, right, what's interesting to me is that they actually talk about their 6 innovations. Now, the way that they handled this, right, was actually quite bad. They actually told people that they're going to shock the world, but actually it's not that shocking. However, when I look objectively at it, the 6 innovations are actually good for their core business. So basically, Alex Chris and his team has already told us, right, whatever that the previous management brought on that does not serve PayPal core business, they're going to sell off all those components of the business so that they become more profitable. And these 6 things, yes, it did not shock the world. Actually, it's nothing super ingenious. However, it does really make the business better, and I'll explore that in another video. But I'm just going to take you through very quickly the 6 things that they talked about. The first of the 6 innovations, right, is basically how they basically transform checkout by using fingerprint and Face ID. I can't believe that they were not able to do that previously, because now everything I pay is really using Face ID. So of course, this definitely reduces friction. Now, if you don't let me use fingerprint and Face ID, I'm not going to use your platform for sure. So basically, they say this reduces checkout speed by 50%, which I definitely can attest to. I don't use any apps and things like that if I cannot use my Face ID to pay, because it's so troublesome to have to log in and then to make payments manually and things like that. Second innovation is Fastlane, which I really like. Basically, the customers can actually save their information with Fastlane, right? And then they can actually pay using PayPal without having to actually log in or key in credit card details and things like that. So actually, I didn't realize the number was so big. They say about 25% of all retail sales, right, online actually stop at the checkout page because people don't want to key in the credit card number. So while this is not revolutionary, like I said, it really helps to protect their market share, and it makes it easier for people to use their products. I don't want to go into too much detail. The third and fourth things, which is smart receipts and basically PayPal Advanced Offers platform, has to do with basically their move into ads. So they're using AI to basically analyze people's buying behavior, and they have this data because they process so many payments, right, that they're able to recommend to the merchants what are some possible next items that their customers want to buy, so that the merchants can actually show you these things as part of basically advertising to you. And basically, because PayPal customers have a 45% open rate of their receipts actually after buying the thing, which is quite surprising. I don't really open my receipts after buying stuff, but PayPal say that their customers have a 45% open rate. Then I think this is something that is quite enticing for the merchants, because imagine I sell you something, you're going to check the receipt, and then based on whatever you bought from me, I'm able to advertise to you the next item that you may want to consider buying on the receipt, and then attach a coupon code or some sort of cashback offer onto that receipt as well. So that is something that is definitely going to be enticing for the merchants. The fifth thing they did is basically to reinvent the PayPal app and introduce Cash Pass. So basically, they tie up with certain companies like eBay, Max, and Ticketmaster and things like that to offer rewards to their customers. And they also basically revamp their Venmo business profiles for small businesses. So basically, these are things that the company is looking to do. They actually mentioned that this year is probably a transitional year for the company as the new management are getting settled in. They're actually, in the sense, getting rid of divesting some of the portions of the company that does not add on to the core business of PayPal, which actually the previous management brought on, and then they are still basically steering the ship in the right direction. So they did mention that 2024 is a transitional year. So starting a position here, I don't want it to be more than 20% of the portfolio for the very simple reason. If they tell me it's a transitional year, then I don't expect revenues and all that to grow very significantly. And because of that, and we having such a small portfolio, I do not want to be overexposed to something that may or may not grow so significantly. So I think this is like the SoFi play. It's more of a 2026 play. But I think one thing that really attracts me to this company is their high level of share repurchases. So they are basically lowering their share count each time, which means that we can see a very big increase in the EPS. So if you ask me in terms of valuation, I think this is worth somewhere in the 90s to probably low hundreds very easily. Depends on your assumptions. It can actually be up to $120, $130 per share. So it really depends on your assumption. But just on the surface level, right, if you take a look at it, back in 2020, they had revenue of 21 billion. Today, their revenue is about 30 billion. And their operating income was about 3.4 billion back in 2020, and today is over 5 billion. So basically, their revenue is up 42% since then, and their operating income is up 47% during the same period. And over these last 4 years, their stock price is actually down 80%. So I think you can say that PayPal is at a very cheap valuation today. So moving into August, right, because after listening to Tesla's call and basically seeing their result, I'm actually quite confident on energy. But because Trump may likely win the presidential election, right? Even Elon Musk said that then if Trump wins, then I'm probably not going to build my Mexico facility so fast, right? He's pro-business, but not necessarily pro-green energy, which is why I'm actually quite glad that we are out of the Enphase position. I think Enphase will perform well with Trump, but basically not as many tailwinds because there are probably going to be lesser solar credits and things like that. I really don't know. This is just a guess on how the policy will unfold. But to me, if I want energy, then I might as well go with Tesla, right? Because they have an energy business plus their car business, and they have Optimus and then FSD and other services as well. My problem with Tesla right now, maybe in terms of valuation, it takes a bit of stretch of my imagination to get there. However, the investment thesis is one that I really like. If it goes below 200, then that is something that I really want to consider as well. And I think one of the problems with me investing in Tesla with such a small portfolio, right, is that because I want to use options to basically maximize my returns in this portfolio, and I can't buy 100 shares of Tesla at the moment. Now, which is why I will definitely think twice about this position. I do not want to just buy the shares and then just leave it there for capital appreciation. And I think that when I listened to the earnings call, actually listening to Tesla's earnings call actually made me reconsider whether or not I actually want to get into Nvidia. And Nvidia is actually at about $114 per share right at the moment, which means I could actually buy 100 shares and sell options on that. And when I was looking at the options, the volatility is actually quite good for me to buy and sell options on Nvidia. So that is something I really want to consider as well, because like they said, right, Tesla are basically forced to make Dojo good enough to compete with Nvidia because they cannot get enough Nvidia. So basically, the demand for Nvidia chips and everything are basically not dying out anytime soon, and because of that, I'm looking to see whether or not it actually makes sense. So moving forward in the weeks ahead, we're going to be quite busy in the sense that we're going to do the SoFi review. We're going to do the review on Tesla, Nvidia, and PayPal as well, and to see what are going to form the core components of this portfolio. So as it stands, right, next week I'm looking at SoFi earnings, PayPal earnings. The SQQQ position that we have, I already sold 3 contracts. We have 7 contracts remaining. I plan to sell them at maybe about the 150 to 180 level, or even $2. So it really depends. Depends how the market goes from here. I actually expect the market to bounce back a little bit, maybe in the coming few days before correcting even more. Like I said, I was looking at the 430, 435 kind of level. So the next thing I will definitely be considering moving forward is another position in this portfolio apart from SoFi and PayPal. Tesla and Nvidia are 2 that I actually talked about, but the third one is actually Intel, especially if Donald Trump becomes president and they want actually to bring back manufacturing into America, right? Then Intel could be a company that benefits from that. So how do you invest in a bear market in a correction? Basically what I've done over the last couple of weeks is basically to control my emotion, to have good risk management, and at the same time to free up some cash on hand going forward into August, and I'll see you in the next one.